Well, welcome into the Money Wisdom podcast powered by Johnson Bernetti. My name is Jake Dozer, certified financial planner and advisor on the team here in Connecticut. Of course, joined by my partner here, Nick. Nick, introduce yourself if you would.
Jake, thank you as always. Listeners, viewers, thank you for being with us. I'm Nick Colantuno. I'm a certified financial planner up here in our Boston, Massachusetts offices. We're glad you're back with us on the Money Wisdom podcast.
So today, and historically we've done this as well, we've sort of tried to answer questions that people have sent in to us, whether they come in for a complimentary consultation and they have questions that we hear, whether it be the questions from our clients or feedback from listeners and viewers like you, where maybe you have a question or you have feedback and there are things that you find interesting and want to make sure we talk about. We want the show to be as relevant as possible. Instead of trying to throw content at the wall, our goal is to make it relevant to what we're asked about. And so to that end, the question we have in front of us today, and I think it's at the heart in one way or another of most concerns that retirees have, is your 401k going to be enough for retirement? Now, obviously, every retirement account is a little bit different. You could hold your assets in an IRA, an individual retirement account, a 401k, a 403b, a 457, a fill in the blank with your flavor of letters and characters mixed together. But when it all comes boiled down to, it's this, is do I have enough money to live the life I want? So Nick, start us off. When we're thinking about 401ks and when we're thinking about, do I have enough? What are the things that we need to be thinking about? What goals do we need to be setting for ourselves so that we can really answer this question definitively?
We use the saying all the time, Jake, that you just need to know your numbers. And at the core of the concerns that folks coming in and sitting down with us are facing, it's, as you mentioned, it's as simple as those two questions. Do I have enough? And really the question behind the question is, Nick, Jake, am I going to be okay? Right. So whenever we're building financial plans for people, whenever we're trying to answer those, frankly, vague questions, we need some pretty specific details in order to arrive there. And at the core of any financial plan is really just figuring out your numbers, knowing what your income sources are, knowing what your expenses are, and then ultimately knowing what assets you have with which to make up the difference between what's coming in and what's going out. So at the core of this listener's question is, will my 401k be enough? I mean, that's a do I have enough question. Whenever we're arriving at do you have enough, it's often coming down to a few things. Like I said, what are your income streams? Do you have Social Security? Are you fortunate enough to be, one of the lucky ones who still has a pension benefit, even though they're few and far between these days? Do you have rental income? What sort of interest and dividends do you have as far as, what we like to call the mailbox money? You wake up on the first of the month and you know what dividend's being paid, or you're getting certain amounts of interest, So what are those income sources? What's the taxation of those income sources? And then really, what's the difference between what's coming in and what's going out? And what do you have in the background to work for you? Now, when we answer that work for you question, that's where we have to get to the core of your comfort level with risk and time horizon and liquidity needs and all those other, financial planning concerns that we have to address. But we're almost on this podcast every week, Jake, and we're just telling people, the importance of knowing your numbers. So that's where we start. How do you arrive at where we're finishing?
Yeah. So to your point, we first need to know what target we're shooting for. What does enough mean? And how do we define it? We define it by what deficit in your cash flow on a monthly basis do we need to come up with from investments? And again, this question was around 401ks, and we'll talk about the different options here in a little bit. But, whether it be 401k, IRA, whatever the account is, the difference when you're in your withdrawal phase of life is what investment options do these accounts provide me? And then mostly how much is in them. That's really what it comes down to first. We have to first determine how much you need every month, how much is in that account, what investment choices to select from the account. But beyond that, the next thing we need to think about is how are we using that retirement account while you're working? So when we're thinking about, do you have enough? We're thinking about how much do you need to spend out of it? And therefore, math can tell us how much you need as a lump sum. Right. But then the second part is, while you're fueling that account, how do you address the answer? If someone says to me, hey, Jake, I've done this analysis and you told me that I have 80% enough in order to retire. What's that mean for me? Well, we can pull different levels. We could reduce your spending. We could change your longevity that we want to provide for. But most people don't want to make those changes. They want to kind of live the life they want. And so the second step is, since assuming we're getting ahead of this thing and you're still working, it's let's know the rules on how we can get money into this 401k. So with that being said, a few thresholds that you need to be aware of, and this data is as of the passing of the one big beautiful bill, whether you think it's beautiful or not, either way, it's law. And so we need to be aware of what parameters, and there's some adjustments that have been made in recent law passings. And so to that end, your standard deduction, which is if you're below age 50, is $23,500. Your catch-up contribution for those folks who are, this is where the big beautiful bill changes things, ages 50 through 59 and ages 64 and older. That is $7,000 per year per person. And then finally, there's a new catch-up rule that changes based on your age. That catch-up rule, again, if you're past this age, is, and this one applies to folks who are ages 60 through 63. Why in the world would the government make this complicated? I don't really know, but we're just playing the cards we're dealt. So that separate catch-up is $11,250. So basic, everyone can do 23.5. Second is if you're 50 to 59 or 64 and older, you can do $7,000 a year on top of that. So 23 plus 7. And then finally, if you're 60 to 63, you can do 11,250. So that's the amount of money that can go into these retirement accounts. So then we have to determine, all right, if you have a shortfall in your assets, how much of each of these contribution methods do we need to take advantage of? And then finally, we need to be thinking about, if I'm doing any of these catch-up contributions, should I be taking advantage of pre-tax or Roth? For a long time, the default option, if you will, was pre-tax only. And then in the late 90s, Roth IRAs became available. And then eventually Roth 401ks became available, to the point now where more people have 401ks that are Roth available to them that don't have Roth. And so at this point, now you need to know, which one am I contributing? And that's a decision based on, what's your tax bracket now? What's your tax bracket in the future? What do you want retirement to look like? So we segue from what account holds my money and is there enough money, to how am I using that money, contributing and withdrawing? And then how am I taxed upon that money going in and coming out? And then one thing as a quick caveat to be aware of before we talk a little bit more is, if you are doing catch-up contributions of any flavor, starting in 2026, the government is required that catch-up contributions be to Roth. So obviously that's telling their hand they want the revenue from taxes that come from your Roth contributions, of course.
Yeah.
But just
let you put more money in.
That's right. So, but just
we're getting our piece of the pie. Yeah.
That's right. And just know, folks, is that if you're doing those catch-up contributions and you're not doing Roth right now, that means that starting in January 26, that's going to change. And that means that at minimum, if everything maintains the same thing, your take-home pay is going to go down. Because when you put money into a Roth, you're paying taxes out of today's income for tomorrow's growth. So your take-home pay is going to go down. So whether you want to deal with Roths or not, in the next few months, you're going to have to deal with Roths. And so you need to be aware of, how does this apply to me? So many moving pieces. I think this is a good place to take a pause. If you're out there saying, my word, my head is swimming because this world is jargony and there's all these different levers I need to pull, how much to put in, how much to take out, how much to have in there, which tax rates, what options do I choose? I think that we have a resource that would really help you with that. And Eric, one of our partners here at the firm, wrote a book years ago called The Ultimate 401k Guide. And if you'd like to get your hands on that, we'd be happy to send it to you with no cost, no free of charge. It's just a way to be able to sort of dive deeper into some of these things you need to be aware of. So again, if you want to get your hands on that Ultimate 401k Guide, we'd be happy to send it your way. Simply text the word guide to 800-757-0436. Guide is spelled Guide. This information is, of course, available also in the show notes, whether you're listening or watching today. 800-757-0436. We'll send that guide your way. So we've talked about kind of the levers to pull. I think the natural next conversation is when you're thinking about investment vehicles, not the investments themselves, stocks, bonds, mutual funds, all that stuff, what holds those accounts. We've mentioned a few here and we've talked about 401ks, but Nick, alternatively to a 401k, what other options are available? And maybe we can talk a few pros and cons with each of those accounts.
Yeah, absolutely. Most workplace retirement plans, right? The ERISA accounts are going to be the 401ks, the 403bs. Anytime you have money under the umbrella of an employer sponsored plan, naturally you're going to be somewhat restricted as far as your flexibility and your control over that money. Obviously, the job of the employer is to make sure that they're providing what I would say is an adequate buffet of investment options for, most people. Now, again, you think of how your employer works out there. You've got some 25-year-olds in your office and you probably have some 75-year-olds in your office. So, the job of the employer is not to say, okay, we're providing you with everything. We want you to have total control and total flexibility over that money. They've got to keep some guardrails in place, which is often where we get to these alternative accounts, primarily being IRAs, individual retirement accounts. Now, folks, if you're working with your current employer and you are not yet 59 and a half, well, unfortunately, you probably still have to keep that money in the 401k.
Right.
Now, if you have money with a previous employer, even if you are not yet 59 and a half, you can take that money with you. I always use the saying, Rule 101, you leave an employer, take that money with you. What I'm getting at is don't take it out and put it in the bank where now you're going to have to pay taxes on it all at once. Move it from the 401k or from that 403b into an IRA. Now, the important thing when doing that is you're maintaining the tax deferral of that money.
Mm-hmm.
The benefit is inside of an IRA, unlike a 401k or a 403b, you can get access to the whole world of investment vehicles. And of course, you don't necessarily want to be going at that alone. That's where a lot of the work we do for our clients comes in from an asset management standpoint, is just figuring out, okay, now you have total control and total flexibility over this money. How should it be invested?
Right.
Should you have all of that money in a place where it's going up and down every day? Likely not. The fact of the matter is a lot of people within their 401k plans, they do have that high level of market exposure, whether they're necessarily aware of it or not, just because that's where the money in those plans lives.
Right.
So oftentimes, another value of moving that money to an IRA is being able to get access to things that you can't get access to in the 401k plans, not just things like individual stocks or certain mutual funds that you like or ETFs, but things that don't even live in the market world. This is where we can get into vehicles that are living in that insurance world, things like annuities, whether it's fixed annuities or fixed index annuities. Vehicles that can get you market-like exposure and market-like rates of return, but without the risk and in most cases without the fees. So again, just anytime you can have more flexibility and more control over your money, because at the end of the day, folks, it's your money. You should have flexibility and control over it. It often makes sense to explore those alternatives. And that's where, Jake, you mentioned this book, The Ultimate 401k Guide. It talks about why you would roll money out of an employer plan, why in some cases it might not make sense to roll money out of an employer-sponsored plan.
Right.
But again, whenever you turn 59 and a half or whenever you leave an employer, in most cases, it's going to make sense to take that money with you.
Yeah. And I've even heard it said, and this is a general rule of thumb, but I've heard it said that there's really only 4 reasons one would leave money in a 401k upon retirement. A, they're going to retire between ages 55 and 59 and a half. Typically, you can't touch retirement assets without a penalty until you're 59 and a half, without very few exceptions. And if you touch it before then, you get a 10% penalty. Well, there's a special rule called the Rule of 55 that says if your most recent employer, where you had a 401k, you leave it after age 55, but before 59 and a half, you can touch your 401k without that early withdrawal penalty. Just be aware. That is a general rule that I gave you a high level. So if you're listening, do not do that without talking to somebody and looking at your plan, right? We always want to caveat that.
Yep.
Number 2, of course, the second reason to leave money in a 401k might be if you're going to work post age 73, or more specifically, post RMD age, required minimum distribution age. If I'm 74, for instance, and I'm working at my job, I normally would have a RMD, a forced withdrawal, a required minimum distribution. Because my 401k is my current employer, however, in this example, I'm exempt from that rule. So that might be an area where, from an income planning perspective, it makes sense to leave it there. Reason number 3 is you might have a highly appreciated stock from the company for whom you work. So if I go work, I'm thinking here in Connecticut for Stanley Black & Decker. I've had clients like this, Stanley Black & Decker, and they've had that stock for 30 years and they bought it for $10,000. And then now it's grown to $1 million. That sounds like a crazy experience, but I've literally have 2 clients I'm thinking of right now who had that experience. Well, there's actually a way for them to extract that stock through a process called NUA, net unrealized appreciation, where they're only paying income tax on the basis or the principal and paying capital gains tax on the gains at a later date. That is a measure twice, cut once type of experience. And again, because it's so nuanced, do not go that alone. Work with somebody who knows what's going on there, an accountant or potentially both. And then number 4, there are rare instances where a 401k at your employer, typically this is something you're grandfathered into, where a 401k provides a safe option called a stable value fund. Most 401ks only have one safe choice, safe principal protected choice, which is cash, stable value fund, money market fund. I'm using those terms interchangeably, although there's subtle nuances. But in essence, they're cash. Normally, they only pay like 2%. But every once in a while, in a blue moon, we might come across an employer that I'm thinking of a town that 30 years ago had a 4% guaranteed fixed rate account. Well, that's not a bad fixed rate option. And if you want to become safer, perhaps we should leverage it. You get your money out of 401k, you can't leverage anymore. But again, that's like once every 3 years I see that. And so if you're out there looking to say, why are the exceptions applying to me about why I should move my money, you might be missing the boat, because the reality is most folks move their money from a 401k to an IRA. Whether they're working with an advisor or not, it gives you more choices. And generally speaking, when you're on the precipice of retirement, you have the most money you'll ever have in your life. And if that's the case, then why subject yourself to a McDonald's menu when you have steakhouse money, if you will?
Hey now.
So with that being said, you need to be thinking about cash flow in and out. That really should predicate your decision of if you have enough. Do I have a deficit? Do I have a surplus? What does that mean for my retirement? Number 2, you should be thinking about taxation, going in and going out. Taxation should never sort of drive the car, but it should certainly be in the passenger seat. You shouldn't not spend your money because you're afraid of taxes. But at the same time, you should allow tax rules to inform your spending and the pace of your spending. So don't be subjected to them, but allow them to inform your decision making. Number 3, based on your spending habits, and when you want to retire, you should be thinking about, when should I pay taxes? Through contributions, through conversions, through withdrawals, and then forced withdrawals like RMDs. And number 4, investment choices. And then filter that situation by situation with an expert to say, am I one of the exceptions? Lots of moving pieces here. Nick, what concluding thoughts would you give, if any, when we're thinking about all these options and what selections to make, and if people are going to be okay?
Yeah, retirement is just such a different phase of life for everyone, but particularly for our clients when they're thinking about generating income. So I know a lot of what we've talked about today and a lot of what we touch on in the 401k book is like, why move 401ks to IRAs for flexibility and control of your investment options. For a lot of our clients, they're making that move from 401ks to IRAs for flexibility and control of where they're getting distributions from.
Right.
When you have money in a 401k, you can't necessarily specify which fund you want to sell out of. Meanwhile, one of the funds might be up, one of the funds might be down. We might want to leave one alone and, take money out of another one. But again, you talk about flexibility and control. When we're building plans for our clients within these IRAs, we are very deliberately coming up with strategies where we have different buckets doing fundamentally different things within those accounts. And that oftentimes is just not the case inside of these 401ks. So again, it's not just about flexibility and control over what you can invest in. I would really argue more importantly than that, for our clients in this next phase of life where they're taking money out, it's flexibility and control of where you're going to go to get your hands on money when you need it. So
well said.
Not just having a plan for growth, but really having a plan for income. And as we talked about, on the onset of this episode, Jake, was also having flexibility and control from a tax standpoint. So,
Right.
I almost like the idea that they're now forcing catch-up contributions to be going into Roth accounts, because at the end of the day, nobody wants to pay taxes when they do those Roth contributions, yet it's almost everybody we talk with wishes that they had money in that Roth world. So now that they're not really giving you the choice, it's, I don't hate it. I know
like
nobody likes being
choice, but I
told what
do.
to do, but
Yeah.
yeah.
I like the idea
Exactly.
of choice, but at the same time, I think you're right. It forces people to diversify from a tax perspective.
Yeah.
And I think that, Nick, what you said is so true. I think that if you're sitting here listening, and maybe you've listened to all 20 minutes or so of our episode, if you only have one takeaway, is don't consider that idea of control a buzzword. Recognize that the two places control matters the most to you in this discussion is A, which fund am I going to sell to withdraw from? Because it doesn't matter if you have all the money in the world. If you don't know how to get it or use it, it doesn't serve you well. And if a 401k does not allow you to pick and choose which fund to use in retirement, then that means that you're always just broadly touching each of your money streams individually. And now your diversification only helps your portfolio not fluctuate, but it doesn't allow you to really make income-related decisions specifically. And it kind of misses the forest for the trees. And so that's probably the most important thing if I'm only walking away with one thing today. Again, I know there's a sea of information out there. If we can help, please reach out. Let us send you that 401k, that ultimate 401k guide your way. Simply text the word guide to 800-757-0436. We'll send that out to you. Or if you say, all right, I got to figure out what this means to me. I'm ready to move from concept to the rubber meeting the road. Text that number, reach out. We'll schedule a time for us to have a complimentary consultation with you and figure out if this applies to you. Again, this is the Money Wisdom Podcast. We appreciate you tuning in. If this episode has been helpful and you think it could be helpful for someone else, share it with a friend. Like and subscribe so you see these videos. And Nick and I will see you next time on the Money Wisdom Podcast.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.